This is a series that was born out of some informal discussions between our three firms at various times, and we realized that there was a lot of expertise around the table, and we could probably come up with some nice advice for our mutual clients. That we tend to go off on one-offs, and why not put us all in one room and give you all an opportunity to ask the experts if you have any questions. It's a high-level overview of many of the topics. It's meant to create some pain points, possibly, some questions that you may not have thought about, and certainly will be around later. We'll be glad to answer any questions you may have. This is the first of a four-part series. So this one's establishing your business. Then we've got growing your business, protecting your business, so IT and IP protection, that sort of thing. And then the last is exiting your business. There's a real nice fit between growing your business and exiting your business as well, because on the growing business, your business piece, we talk about evaluating your business and how to make your business more worth more, so you can get more when you exit.
When a client comes into the Royal Bank and wants to talk about financing, a lot of times the client will come in and just say, I have this business plan, how much money can I get? We typically have the conversation of, well, we don't need to know how much money we can give you. We need to understand how much do you need. A lot of times we're the first point of contact. We're there. Our doors are open. We want to talk to our clients about their financing needs, but at the same time, the client needs to understand their own ways of raising money. So my wife, she runs her own business, and right now it's a very simple business, but she's looking to transition to another business. So right away, I'm a banker. I know that today we have X amount of money in our bank account. We have X amount of equity here if we want to invest. Plus we have, grandparents that may want to help us along. So we talk about personal funds from savings. So that could be from your savings account, equity in your house. We want to understand that when we're writing a proposal in terms of where you're going to get your money from. And also you need to understand that might be the cheapest way to get money for your business. Love money, friends and family. Hopefully they're not charging you an interest rate, but you never know. If it was my kids, or Peter shared with me at times, if it was his kids, he would have terms and conditions and an expectation. So this one's a great one. Part-time job or steady sources of income. So with my wife's story, I'll be working full-time. So this money hopefully will cover all of our bills, and she could take that leap of faith, which is always great. The next piece is looking for outside shareholders or investors. So I like to tell people finding a mentor or somebody who can invest in your business and help you grow is always a great way to raise money. And also it gives someone a vested interest in your success beyond just you, your family, and hopefully the bank. Another one that's a little different is suppliers. Suppliers are a great way to maybe borrow money from them in the form of inventory. So they may give you terms and conditions that really help extend any cash flow crunches. So those are some traditional means of financing that would not typically come from a bank. So when a client comes in and they have kind of taken inventory of what they can bring to the table in terms of money for their business, they may not need us, which is okay. We'll take care of their bank accounts, getting their Visa cards, their overdrafts, but a lot of times their project and scope may be outside of what their savings are. So typically as a bank, we'll look at term loans. We do use the Canada Small Business Financing Program, which often for startup, because it is a great way to lower your risk in starting your business because of some of the personal guarantees and structures of that financing loan. Operating loans, often referred to from clients as credit lines. I very quickly correct that, because a credit line often it's people will borrow the money and pay later, whereas an operating loan and an overdraft is really about cash flow management. They're really a tool to bridge gaps between when something is due and when you're going to get the money. So those work out well. Corporate Visa cards, they have the 30-day interest-free period. Those are great ways to purchase inventory, and hopefully you're turning your inventory quick. Letters of credits and guarantees, really a product that is used from a lot of different places. It's a guaranteed financial instrument. We don't see a lot of these with startup, but when we do, it's a little bit more of a conversation. Equipment leasing, RBC is continuously increasing their focus on leasing. It's a great segment of the market that has a great benefit to our clients and in the financing proposals. So something to just think about if you're looking at specialized equipment or large equipment purchases, that could be a great way to finance that. Non-traditional means of financing. So we're in Ottawa. We hear a lot of this, in the news or whatnot. But equity angel investors, venture capitalists, or even public market. These are, of course, different ways of raising money depending on your idea or your products or services. Could be a great way to go. Subordinated debt, mezzanine financing, and asset-based lending. Again, typically larger-based financing that requires more of a conversation with your other partners, your accountants and your lawyers, along with your bank. And then factoring, so looking at financing your receivables in some way. If your receivables get too long in a government town, they tend to get long if you're dealing with the government. So maybe you do need to leverage your receivables so that you can continue on with your business. Government programs. So when you think of different, a lot of times clients will come to me and say, is there a government grant program or something that I can go out and they'll just give me money? Well, freshfounders.com is a great resource to find certain grants that are available out there and explore a little bit of opportunity. Ontario Centres of Excellence, community loan funds, there's some all throughout the province. I've seen clients get very, very favorable terms on some of these loan funds to help expand their business. And what's in it for the local community is that they're employing additional people, so it's really a win-win for everybody. IRAP and SRED credits. Normally talk to your accountants about what can you do in this and explore those programs.
So I'll just take a few minutes and talk about various different, or some of the different structures that can be used in carrying on a business. We often get this question when someone is starting up, should they incorporate or not? So there are a number of things to consider. A big one is obviously the taxation, and so tax factors are a big consideration, but there are some other factors. And also want to keep in mind that these structures can be very fluid, so you're not necessarily tied to one once you start up that way, so it is possible to start out as a sole proprietorship and evolve into a corporate structure and even get into a much more complex corporate structure if needed. And so I guess we'll just talk about the sort of three more common ones that we'd see: sole proprietorship, corporation. I'll touch on partnerships a bit, but they really are intended for more very specific purposes. The taxation ultimately depends on who the partners are, so that's not really a big issue there. We'll, though, just to give it some context, talk about the taxation of corporations and individuals and how business income is taxed in each and how it is integrated, because that is a big factor when making this decision. So when we're looking at business income, so again, this is not investment income or rental income. This is income from a business. An individual, if there is any income over and above $509,000, that is taxed at a very high rate, so about 49.5%. Any income falling within the range of $135,000 up to $509,000 is taxed at a slightly lower rate, 46.4%. And so those are generally the rates that we look at, or the brackets that we look at when we're doing these types of analyses. So just to compare to a corporation carrying on a business, the first $500,000, assuming that business is in Ontario, is subject to a pretty low rate, so 15.5% corporate tax. Anything over and above $500,000 is taxed at a higher rate of 26.5%, but you'll notice that it is significantly lower than the personal tax rates. And so this is where I'll get into a couple of schedules here, but obviously this does indicate that there are probably some advantages to a corporate structure. I won't get into the details of these numbers, but really all this is showing, so it's these last two lines that are key. We're just trying to compare if a person incorporated, so that corporation earned a certain amount of business income, paid the corporate tax, and then with the after-tax money, you just paid it out as a dividend to the individual, and then the individual paid personal tax, how much would be left compared to if the individual simply was not incorporated, earned a certain amount of business income personally, paid personal tax. And so the last line here shows there's about a 1.4% tax saving by incorporating, paying corporate tax, and then paying out a dividend and paying personal tax on that, as compared to not being incorporated. So that's not a huge saving. It's not I don't think anyone would decide, well, I'm going to incorporate to save 1% or 1.5%, unless it was a very large number. The key is this line, though. So this deferral of tax, and what this comes down to is, if an individual does not need all of the income that's being earned from that business, if they don't need that for personal use, by paying the corporate tax, leaving that money invested at the corporate level or moving it up to a holding company, something like that, you can defer between 31 and 34%, where if this corporation is subject to that low 15.5% tax rate, so that first $500,000. So if you think of a business generating $100,000 of extra cash that you don't need for personal use, if you earn that personally, you're paying 46% tax or even more. If the corporation were to earn that amount and you just left it in the corporation to buy real estate or invest, you'd be left with an extra $30,000 to $34,000. And so obviously, year in, year out, if you're generating that surplus cash, it can build up. That compounding can be pretty powerful as far as building up a pretty big nest egg at the corporate level. And if it's just being invested, people are usually indifferent whether they're invested personally or in the corporation, obviously if they don't need the money. This is a very similar slide, but just comparing where the corporation is earning more than $500,000, so it's subject to that higher tax rate of 26.5%. You'll see here that there's a slight cost ultimately to incorporating, but still a significant deferral of tax, so between 20 and 23%. So I mean, if someone knows that in the end they'll pay an extra 2% of tax, but maybe it's 20 years down the road, if in that time they've deferred over 20% tax, it's probably worthwhile to incorporate. So just to get into some of the pros and cons of the various structures, I mean, a sole proprietorship, I wouldn't even say it's a structure. It's really just the individual carrying on a business in their name. They may operate under a trade name or something, so not necessarily their own personal name, but they are taxed personally on that income. So it is obviously the simplest structure. It involves the least administration, and there is no additional filing. You file your tax return. You may have HST returns and that sort of thing, but that would be required under any structure. This is the simplest. Losses, so you alluded to this, where someone has started up a business, they often may have other sources of income, so they may still keep a job and start up a business part-time, or they may have other sources of investment income. Any losses realized from a sole proprietorship can be offset against any other source of income. So some people do go this route if they think they will be incurring losses in the beginning. And again, it is very fluid, so you can always transfer that business to a corporation if it makes sense down the road. So, and we do see that fairly often, especially where someone maybe isn't certain whether they will be able to make a go of it. So they may think, well, they don't want to spend the extra money and just the hassle of incorporating. Maybe they'll see how it goes for a couple of years and then move into that corporate structure. I mean, some of the drawbacks, though, potentially unlimited liability. I mean, this doesn't. I'm not talking about where someone's provided a guarantee. This is the sort of unexpected, unforeseen issues. Someone gets injured, or feel that you've infringed on their patent or something like that. They could conceivably come after your personal assets. As far as income splitting, once a business gets more profitable, you may look at ways of shifting income to family members. If you're carrying on this business personally, there's, aside from paying a salary to a family member, and it should be reasonable in light of the services being provided. I mean, that's the only income splitting opportunity. So you'll see with some of the other structures, it is a bit more flexible in that regard. And I did mention that you can transfer that business to a corporation down the road if you made sense. But there is an added cost to that. So you're not simply setting up a corporation at that point. You're also having to transfer assets, thinking about what the value of those assets are. Maybe there's some goodwill, some other intangibles, patents, what have you, transfer agreements. So there is a bit of a cost to it to incorporate down the road as opposed to from day one. I won't really touch too much on partnerships because ultimately the taxation is really just based on who the partners are. So the partners could be individuals or corporations, and so as far as the tax advantages or disadvantages of each, I mean, that can be achieved regardless with a corporate structure. So they really are intended for more specific circumstances or ventures. The one thing also to keep in mind though is that you can transfer a partnership activity into a corporation if that made sense. They are relatively easy to unwind, so the property can generally be distributed to the partners without any tax. You'll see with a corporation that's a little more complicated to do. But really a partnership is a flow-through entity, so whatever income or loss is incurred by the partnership just flows out to its partners. The one where we do see it as somewhat limited is with estate planning and income splitting. CRA doesn't like using partnerships to do an estate freeze or income splitting structures, and there are rules that would allow them to sort of arbitrarily reallocate any income if they thought you were being unreasonable. And so it can be done, and we have seen it done, but keep in mind that it is a little more difficult and challenging as opposed to a corporation. So with a corporation, I mean, there's a reason that we do see it as probably the most common structure. There are a lot of advantages to it, and it is very flexible. We talked about the deferral of tax, so where it's generating surplus funds that aren't needed for personal use. You can really compound an investment pool through a corporate structure. Very easy as far as estate planning and income splitting. The ownership of that corporation can be tailored, within limits, but very flexible as far as getting income into spouse's hands, or if you have children who are not minors. You can really minimize the overall family unit's tax bill as far as even limiting tax that may be paid in your lifetime and sort of deferring it to the next generation. Not possible with some of the other structures. Optimizing remuneration. So an individual has a choice to take salary from their corporation, or they can take no salary and still receive dividends, or it could be anything in between, so any mix of the two. And so this is very flexible, especially in the environment the last few years where corporate rates and personal rates have changed. So corporate rates are coming down, personal rates have been going up lately. And so on an annual basis, an individual can decide how they want to draw money out of their corporation. And they can set that annually as far as what will minimize tax or meet their future estate planning needs. And a big one is capital gains deduction. So individuals in their lifetime, everyone is entitled to, right now it's $750,000, but starting in January 1st, 2014, this goes up to $800,000 of tax-free capital gains on the sale of shares of certain qualifying corporations. So it has to be what's called a qualified small business corporation. Certain tests that need to be met, but just keep in mind that if a person, if you were carrying on a business personally as a sole proprietorship and you sold that, there was a lot of goodwill or something like that, that would all be taxable. Whereas if you could sell shares of a corporation instead, that goodwill is in the corporation, but if you're selling shares, you can access this capital gains exemption. And for someone up into that highest tax bracket in Ontario of over $509,000, this could be worth almost $200,000 in tax savings. And even for someone within that, what used to be the high tax bracket, so 135 to 509, savings are still about $185,000. So it can be significant, and in a couple of slides, I'll just show you a structure where you may even be able to really multiply access to that with your family. As far as the drawbacks, I wouldn't say they're significant, but obviously it is a little more expensive to set up than just carrying on a business in your own name. A bit more increased in administration, so you don't just have your personal tax return, you also have to file a corporate tax return. There are corporate resolutions, additional government filings, but provided that added administrative hassle doesn't exceed the tax savings or other savings, I don't see that as a big roadblock. The other one is losses are trapped in the corporation. So corporation is a separate entity. It's a separate taxpayer. To the extent it incurs losses, it can only use those losses against other income it may realize in the future or in the previous 3 years. So that said, though, the losses do carry forward for 20 years. So I think if a corporation hasn't used those losses in that time, there are probably bigger issues than, are you getting that deduction today? And just to wrap up, So this, I mean, the structures can be as complicated or as simple as one needs. But this is just a sample structure that we may see, and works very well, actually simpler than it may look. So the solid lines represent share ownership, and these dotted lines represent beneficial interest in the trust. So under this structure, you have a trust that directly owns the shares of the operating company, common shares. You have the principal who started the business, may directly own a holding company. The trust has been set up for his or her family. So you have the owner or the principal, family members, could be friends as well. And it's also, if possible, a good idea to maybe provide for corporate beneficiaries, so that a corporation could be a beneficiary of that trust. So what you have here is really, I would say, the most flexible structure possible. If the business is sold, the trust would sell these shares, and the trust can then allocate that capital gain among the beneficiaries as the trustees decide whatever is most optimal. So if you think of a situation where maybe it's husband, wife, and 3 children, they could probably shelter up to $4 million of capital gains in this case. So the trust would realize the gain and allocate $800,000 of capital gain to each family member, $400 million tax-free, most likely. Gives the principal ultimate control because they can be the trustee of the trust, decide they want to split up that gain among family members, or maybe they don't trust anyone or have a falling out, and they can retain that all that value for themselves if they choose. Separately, on an ongoing basis, they can split income annually. So the operating company can pay up a dividend to the trust, and the trustee, so maybe the principal or the spouse together, can decide who will receive those dividends. If there are children, maybe some non-minors, but children in university or college, if the parents are paying those expenses anyway, it may be a good idea to flow dividend income out to the child and have them use those funds to pay for the costs. So an individual with no other income could receive about $40,000 of dividends and not pay any tax. And so if you compare someone who's in the top tax bracket receiving $40,000 of dividends, they're probably paying about $13,000 or maybe even $14,000, $15,000 of tax. So that could be an annual saving where children are in university or college, especially where there are multiple kids. And if there happens to be surplus funds that aren't needed for personal use, under this structure, the dividend could go up to the trust, and it can allocate that dividend to the holding company. That would flow tax-free in this case. And then you can just build it up here, invest it any way they choose. And going forward, if they wanted to do additional estate planning as far as the ownership of this holding company, that's possible. So very fluid structure. It's not necessary that everything has to be in place in the beginning. It can evolve over that. And this holding company doesn't even have to be set up until such time as extra cash is being generated. So it could simply be something like this, and as there's extra cash in there, they can set up this holding company, and you can flow funds up to there. So.
Okay, hi, I'm Lorraine Mastersmith, and I'm a partner here at Pearlie's. I practice business law, and my clients range in size from starting in their basement to needing hundreds of millions of dollars in financing. So a really broad range of clients. I do have a lot of clients in the tech field, but I also have clients who are organic farmers. So it's a very broad practice. Here with me is Owen, and Owen practices litigation here, and I thought it would be a nice sort of addition to just talking about the business side of why it's important to think about where you're going in your business and who you're going to partner with and how you're going to establish your agreements up front when you have a little bit of consideration from somebody who assists with litigation, because often what happens is people have the best of intentions when they start, things fall apart a year or two later and they haven't thought about a lot of issues, and then they end up seeing someone like Owen and nobody's happy. So it's always a nice, he has a different perspective to offer in terms of how you can avoid or how you can manage dealing with issues when you get into a litigious situation. So we're going to talk about shareholders agreements and considerations for co-owners. So often people start their businesses either on their own or with one or two other people, and so when you do that, there are a number of things that you should be thinking about. We're going to talk about why a shareholders agreement is a sort of unique agreement. It's different than a buy or sell agreement, which is geared towards something you're going to close a transaction at a point in time instead of a shareholders agreement is a forward-looking document. So we'll talk a bit about that. Things to consider from a governance perspective of your corporation. Share issuances and transfers and funding considerations. These are all things that you should be thinking about when you are getting into business with another person. We'll talk about some other key provisions, and Owen will speak to dispute resolution. So without a shareholders agreement, it's important to think about all companies are creatures of statute. So there are a set of rules in either the Ontario Business Corporations Act or the Canada Business Corporations Act, depending on whether you're incorporated federally or provincially. There's no real legal difference in between the two types of registrations, whether you're federal or Ontario. But the numbers of rules that are set out in those acts are pretty small. They don't extend, they're not extensive. They don't consider all the different things that might happen in your business. There's just some sort of fundamental things that are set out in those acts. So you do have a lot of freedom to decide what you want to do, but there are provisions that you'll want to consider. You might not want to be bound by those specifically. You might want to change how those provisions apply to you. So we'll talk a bit about that as well. So the nature of a shareholders agreement is, as I said, agreements generally tend to deal with something that's going to happen at a specific point in time. A shareholders agreement isn't. It's something where you have to think about all kinds of things that might happen. It's sitting back and thinking through the what-if scenarios. What if, so there's no standard form of agreement because there might be a precedent that you can start with, but it's going to be tailored to your business because you'll have different concerns than other people. It depends on where you are in your life, in your financial circumstances. All those types of things come into the drafting of a shareholders agreement. And so what I tend to recommend to my clients is that you should sit down and think through a bunch of what if scenarios. What if one of my partners becomes sick? Can't work anymore with me? What if one of us has a divorce? What if one of us dies? What if what other scenarios? So what if you just don't like each other anymore, and then you have to come and see someone like Owen? So there's a bunch of things that you need to think through, and so I always suggest a shareholders agreement can be a daunting legalese document. So if you can sit down and start with sort of point form, what things are you concerned about? Where are you at? Would you be able to buy your partner out? Would they be able to buy you out more easily? Who's in a better financial position, or are you completely equal? Those are the types of things you need to think about, and will you have the capacity to buy insurance in case somebody is ill or isn't able to participate any longer? What will you do? So those are the types of things I encourage clients to think about before they sit down and try to manage the big shareholders agreement. The purpose of a shareholders agreement is that, in a small company, generally people need to have a set of rules to govern their relationship, as I've mentioned. So material topics that we usually address are dispute resolution. What do we do if we can't make a decision? If there are only two of us and we are equal owners, what if we can't agree? How do we come to a decision on how to operate the business? If we are unequal owners and there's one of us that only has 20% ownership and the other has 80%, should that 20% owner have any special rights? And that's where you can get into changing what the laws are in the legislation about what rights minority shareholders have versus what approval rights they might be entitled to under your agreement. But that's something that you can negotiate between yourselves. You have obligations in respect of equity and debt financing. If the company needs money, where's that money coming from? Can the company ask each shareholder to put in more money, or can they ask them to guarantee debt financing? We do need to describe specific obligations of the shareholders in respect of those things. The other thing to anticipate is likely future events. So again, you're thinking forward to the so the two of us are shareholders, but our spouses have rights in those shares should there be a divorce. So how do we manage that? Do we want an angry ex-spouse to be a shareholder of our company, or how do we want to have an ability to pay that person out and not have that happen? So those things need to be provided for in your agreement, or you're going to end up in an argument about it. From a governance perspective, so shareholders and directors in smaller companies tend to be the same people. So the shareholders of the company tend to be the directors. If there's 2 or 3 shareholders, those tend to be the directors of the company. As the company grows in size, then there may be more of a separation. You'll have a board of directors who are not shareholders, or you'll have appointees of shareholders to be their nominees on your board. So when you're starting out, typically though, you've got a situation where you're a shareholder and a director, you're wearing both hats. And the shareholders agreement will provide for a mechanism for the appointment of directors. So again, if there's only 2 of you and you're both going to be on the board of directors, you each have a nominee to the board. If one of you, though, is a more significant shareholder, you may want to have a right to be able to appoint more people to the board, because the board is going to operate the day-to-day operations of the company. They're going to oversee the day-to-day operations of the company. If there are major decisions that need to be made for financing, for that sort of thing, the board will decide that that's appropriate. So if you're the shareholder that wants to have a say in that, then your agreement needs to provide for that. The agreement will also set out quorum and other requirements. And quorum is an important thing both for directors' meetings and for shareholders' meetings, because and it's something that often people don't consider until they actually read the provision in the agreement, and they say, well, what happens if I can't be at the meeting? And well, typically we provide for another meeting can be scheduled, but if somebody wants to sort of veto a decision from being made by just not attending a meeting, you don't want that to be able to happen. So you need to contemplate that and think that through. Okay, what do we do in that situation? And there are ways to deal with that. Other things that you can deal with in your agreement is budgets, financial plans, the provision of financial statements. Are you going to have audited statements or not? Are you going to share those with the shareholders, and on what basis? Reporting obligations, and then also your dividend and distribution policies. So are we going to declare dividends every time we have a profit to share, or are we going to put that money back in the business? And you can provide for that in your agreement. As far as share issuances and transfers go, there's a lot of things to think about in that respect. So typically there's an overarching rule that we recommend to clients that don't allow shares to be transferred without the approval of either, if it's just 2 shareholders, both of you would have to approve the transfer, because the issue is you don't want your partner to sell their shares to someone that you don't know, that you don't want to be in business with, because that's going to be your partner. So you want to have a say in that. Permitted transferees would be an exception. So you would have, if I was your partner and I incorporated a holding company, you wouldn't have a problem with me as long as I was still the principal of the holding company, or I created a family trust, as Zoran was talking about. That sort of thing is typically a permitted transfer that you don't have to get any special approvals for. Things like, there's a whole list here of sort of legalese topics, but the idea behind all of these is to provide mechanisms for people to protect their rights in the company. So preemptive rights are simply if there is going to be a new issuance of shares, the existing shareholders would have a right to buy those shares on the same terms as they're being offered to either one of the existing shareholders or an outside shareholder. That just allows you to maintain your ownership percentage. So if you if you don't care if you're going to be diluted, you won't participate. If you have the capacity to participate, you will, to maintain your share ownership. There are rights of first refusal that you can put in as well. So if one of us wanted to sell our shares, you would offer them first to the other person so that they would have an opportunity to buy those shares before you brought in a third party. Owen's going to talk a little bit more about shotgun and auction provisions, but those are typically, just there as they're not for everybody, but typically when there are 1 or 2, possibly 3 shareholders, you want to have a provision where we're not getting along and we just can't get along. We can't agree on a valuation. We can't agree on anything. So I can make an offer to you to buy your shares. You can either accept my offer, or you can sell me your shares on the same terms. So that's basically what a shotgun is. This is something when you're first starting out, and I think I talked to somebody in here about when you're thinking about starting your business and you want to think about where you're going in your business. Don't just dive in there and start and not think about where you're going in your business. So if you're thinking about where you're going to be in 5 years, for example, is it possible that someone's going to want to buy your company? And if that's possible, then you should have some tag-along provisions or drag-along provisions, because what if your partner doesn't want to sell? You find somebody great who's going to pay you a lot of money for your business, but they're just don't want to sell. So you want to be able to have a provision that allows you to pull them in. Typically those types of provisions come in when you have more than 2 partners, more than 2 shareholders. If you have a lot of minority shareholders, you definitely want to be able to drag them, and you don't want them to have an ability to stop you from selling your company. Issues like bankruptcy and death of a shareholder, as I mentioned, those are important things to talk about. How are we going to have insurance, life insurance? Are we going to, also in that is disability. So are we going to have disability and life insurance on our shareholders so that, and is the company going to pay for that? Who's paying for that? And who's the beneficiary of it? And what happens with the proceeds of it? So you need to think about all that when you're preparing your shareholders agreement. It should also contemplate divestiture and dissolution. So if things don't work out and you want to wind up the business, how do you divvy up what's left? Other important provisions are share evaluation mechanisms are very important. Often the biggest dispute shareholders get into is what's the value of the company? If I'm going to buy you out, what's the value of your shares? And if you can't agree on that, if you have a mechanism in an agreement that sets out how you agree on that, then you just follow the process and the number is the number. And then it cuts down a lot on the perspective that there might be a fight about it later on. I included public offerings here. I mean, that's something, again, you're thinking about if that's your goal, then you should think about having a provision in there about what happens on what constitutes a public offering and what happens with the shares of the company on a public offering. Typically, you only see those provisions when you have a venture capital company investing and there's a path to IPO. Then they will sort of dictate what those provisions will be. Funding considerations, you will have share subscriptions from existing shareholders or possibly from new shareholders. Those things need to be provided for in your agreement. I mentioned shareholder loans. And when you have provisions in your agreement about shareholder loans and requiring shareholders to provide loans to the company, you need to think about, okay, well, when do we get repaid? What are the terms? Do we get interest paid to us? All those things need to go into the sort of financial planning for the company. Also, the ability to seek third-party debt financing from someone like RBC. If you were going to do that, they may be looking for personal guarantees, and so your agreement should contemplate whether shareholders will be required to provide a personal guarantee. You'll also want to provide for circumstances where somebody defaults on their obligations. You call for a loan, they don't have the wherewithal to provide a loan. What happens? Perhaps you could buy them out at a discount. There's different ways to deal with that, but it's just something you should think about. So there's other key provisions, and I was thinking maybe I'll let Owen, do you want to talk to the non-competition?
Sure.
And so I'll just turn over the mic to Owen here.
Sure. I guess I'll say at the outset, as a litigator, I come at these issues from a different perspective. So I normally run into clients who have a company or a joint company, and things have gone south in part because they didn't have maybe the right provision in the shareholder agreement, or they didn't have the dispute mechanism provision that allowed them to take a particular avenue that may have been cheaper and more efficient for them. So in this case, as an example, non-competition clauses and other restrictive covenants, having those either as kind of schedules to a shareholder agreement or as part of the shareholder agreement can be a really important part for smaller and startup companies where especially the key shareholders and directors have skills that or client lists, those kinds of things that if they left would be devastating to the company. So it's important to keep them involved. And you may still end up with litigation out of this, but at least it'll be much simpler, and you'll be able to point to what the requirements were for the parties in the agreement rather than kind of depend on the common law at large. So it's important to think about those things up front. And typically, and this goes for almost everything we've talked about, is at the outset when a company is started, like everybody's friends, or you have some kind of business arrangement that makes sense, and there's nobody that's going to be against a non-competition clause at the outset, because hopefully everyone at the table has skills that they want to bring. It's when these issues come up after the fact, once maybe the relationship has started to frail a bit, and somebody's thinking about working outside of that company, that it becomes an issue, and it's too late at that point if it's not in the agreement, because that person's not going to want to include it at that point. It's too late. And then you also want to talk about what are the consequences for the breach. And that's another issue that if you deal with that at the outset, you're going to reduce whatever litigation is necessary, because if you don't have that, you're just going to be asking for everything under the sun, and it can create kind of a prolonged process to resolve the problem. But if at the outset you say, look, if you contravene that and there's a finding, then you have to sell your shares for X price or according to some certain formula, and that makes it a much more efficient resolution. Is there anything else you wanted to add on that?
Sorry, yeah, just one thing. Yeah, the only other thing is, in terms of non-competition, just give consideration to whether all your shareholders are actually employees, because some of your shareholders may not be employees, and so you will want to have non-competition and non-solicitation clauses, because those shareholders will be privy to confidential information about your company that you won't want them going to a competitor. Also, in an employment contract, if all your shareholders are employees, you would want to make sure that your shareholders agreement provides that if they are no longer employees, that they have a requirement to sell back their shares, or that somebody can buy them out, so that you no longer have a disgruntled employee as a shareholder. It's just something else to think about.
All right, so this is the kind of the key issue that I'm here to talk about, and this is when you actually have a full-blown dispute that has arisen, and that can be a small kind of internal matter with the board of directors or between shareholders, or it can be something more substantial. And at the outset, when you're drafting your shareholders agreement, you can set out exactly what happens when there's a dispute. So for these smaller issues, rather than have them build up so that they explode, you can provide for either a mediator or some kind of third-party dispute resolution specialist to intervene at that point and try to resolve it before it becomes a substantial litigation matter or something that causes the company to break apart down the line. So those are the smaller issues. But what's more concerning is when things become substantial matters. And that's when we talk about, okay, do we want to have an arbitration clause? Do we want to have a mediation clause, or do we want to go to court? Because the default is for any disputes under a shareholders agreement, you're going to end up in court, because that is the only mechanism that is available kind of at common law. For those who don't know what arbitration is, it's basically privatized court with mostly either retired judges or retired lawyers that are the acting judges in that dispute. And it tends to be faster, and it tends to be more efficient, and you end up with more specialized decision makers. It can be more expensive depending on the dispute. Mediation is going to happen in the court process no matter what. In civil litigation in Ontario, mediation is required. That's where you sit around a room basically like this with a mediator, and they can't impose anything, but you try to talk out the dispute and find a resolution. That is required in the civil context if you go to court. If you go to arbitration, your shareholder agreement could state that it is or is not involved. So if you decide, look, if we have a dispute, we don't want to waste time or money on mediation because either we're a really small company or whatever it is, we want to sidestep that, you cannot include mediation. So that may be one of the options that you want to have included. The main two clauses that people tend to include for extremely efficient exits to a company, and this is particularly true in companies where there's 50-50 splits, or maybe 33-33-33, some kind of even number of share distribution that results in a deadlock in the company where matters can't essentially be resolved by way of talking things out. You can have an auction, which is exactly what it sounds like. It can be a sealed bid auction or an open book auction where the highest bidder wins the company. You can kind of get a sense for what the ramifications would be and what the comfort level would be in terms of we're just going to value the company and put in a bid and it's sealed, and that way you could end up with a couple of people bidding strategically depending on what they think other people's access to financing might be. An open bid kind of provides maybe a more fair mechanism to get to a number. But typically what we see is a shotgun clause. And shotgun clauses, just like Lorraine explained, are essentially somebody puts together what they feel is fair for the company. That includes a price, the terms of the sale, and they provide it to the other party. They have an option to accept that offer or turn it around and put it back to you, and in which case you are required to accept it. So it's kind of the business equivalent to sharing a cake and saying you cut, I choose, or vice versa. So if you're going to put out an offer, you better make sure that it's terms that you're willing to accept, because it very well could be that the other party will end up with putting it back on you. It seems like an extremely fair option, and it can be, but if there are discrepancies, such as a lack of funding for one particular side, it may not be. But again, let me give you an example. If one party is the skill part of a company that's starting up and the other one is more the financial backer, they're going to have a larger access to funds to buy that company. So they may be able to get it at a severely discounted price simply because the other side won't have access to funds. And the way you can plan for that is, again, in the shareholder agreement with your solicitor, you'll be able to come up with clauses that set out kind of funding options to ensure that the bidding process is fair. That's essentially, I mean, there's also the dissolution option, but for the sake of a company that's doing well, that's not really going to be something that's going to be appealing to either party. I guess I'll just end with this. The worst case scenario of not having some simple language can be hundreds, if not millions, hundreds of thousands or millions of dollars. We acted for a company that was a 50% shareholder of a joint venture. And things started out great. They started, it was actually a website and making tons of ad revenue. Eventually they decided that everybody hated each other, and I won't get into the details of what happened, but it was highly contentious, and to the point where they couldn't agree on when the financial report should be issued and what should be included in expenses and for what side, and if you pay for that expense, can I have mine? And it ended up costing at least over $350,000 in legal fees, and it could have been avoided by one line in a shareholders agreement, which is a shotgun clause. Had there been a shotgun clause, it would have been done before we even started. So that's the kind of important thing that is, it's cheap, it's not expensive, but if you consider these options at the outset, you can save yourself kind of a lot of heartache. And everybody's friends at the start, but you have to, when you're coming up with the options in your shareholder agreement, you have to assume the worst case scenario. And at that point, you'll have those options when you need them, and hopefully you never do. But that's pretty much it. That fair?
Yep. Yeah. So just to tag on to that a little bit is the importance of entering into a shareholders agreement when you're going to partner with one or more other people in your business. It can't be overstated. Often what I experience with my clients is it is a bit of a daunting document. It's lengthy and it's hard to read. But at the end of the day, and often what happens is, clients will come in at the beginning, they're all gung-ho, and they really want to get this in place, and it's the right thing to do, and that's excellent. Everybody's getting along. This is the time to talk about what happens when we don't get along. So this is the perfect time to put all this on paper. But what happens is, because it is a fairly, people are busy with their businesses. They're focused on their business. They're trying to make money. They aren't worried about putting something in an agreement. So what tends to happen is we'll get the first draft, and then it goes to the client and stays there for 4 or 6 months. Might come back with a few comments, but it ends up taking a long time to get this agreement finalized. So in the meantime, what might happen is things fall apart and you don't have the agreement to turn to. So I do encourage my clients to stay focused on it. I know it's a pain, but it is worth it in the long run, because for my clients who don't have this type of agreement that end up in a dispute, it costs exponentially more money to deal with the dispute than it would have if they had just sat down and finished that agreement in a reasonable period of time and signed it up, and then you can put it away. Then it's done. You only have to look at it if something bad happens, basically. So that's just a little piece of advice. There's another thing that I threw in here, just in terms of pooling and voting agreements. There's other ways that, if there are certain matters that, if you have a lot of shareholders and there's certain matters that you don't want everybody to have a vote on, you can provide for one. You can designate one person to have a voting trust or a pooling agreement to provide for one person to vote on behalf of a group. We hope that you found it useful, and we hope to see you again. Thank you very much.